Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, interesting but hopefully very smooth video talking about a position that I opened and closed very quickly because the price just ran up, and that is Braksem. Okay, so it is a position that was in the eToro portfolio, but since by the time I compiled this video, I've already sold out of the position at a nice profit. So, in any case, without further ado, disclaimer: I'm not a financial advisor. I don't know your circumstances. None of what you hear me say is ever to be considered advice. It's just my opinion of what I am doing. So please do read the disclaimer. It is available on replay or in the description. So, okay, a quick plug for the premium Substack group, the Options Mavericks, where I show you my publication on how I create essentially a one-man insurance business model and generate income trading, particularly selling options. Last year, annualized, I did 25.85% return, which is nice. Currently, you're doing about 6.5% if you look at a monthly return. So obviously the year is still ongoing. And yeah, so you can take a 7-day free trial and check it out. Okay, so here's what's happening. Just blown up a little screenshot there from the eToro portfolio. As I mentioned, this stock has been one I've been keeping an eye on for a while. It's a very tricky one to kind of analyze. I finally started to build out a position, and no sooner than I did that than there are rumors of a buyout offer, and so the price obviously went skyrocketing, and we sold, and now we're just going through the investment thesis. So recently, Braksem received a payout or a buyout, all cash deal, I believe, from Apollo. It's all very kind of hush-hush, rumor orientated, but apparently it is legit. This has been completely copied and pasted from the newsreel. And so, yeah, and most of it's going to be paid by cash. They've got another 7 hash worth to be paid by warrants. It's no big deal, not a big dilution, I don't think. And yeah, that's you get in and your stock gets bought out at a 79% premium. You've got to do what you've got to do in that case. There's not too much more to be said. So it'd be interesting to see what happens with all of this and to see whether this group can do a lot with the company. So, what is the company? What do they do? It's a chemical and thermoplastic resin producer. So interesting cyclical business, but very important. A linchpin, I would suggest, between raw energy and creating products that we use all around the world every day. Centered in Brazil, but has markets in the US, Europe, and Mexico. A lot going on in Mexico at the moment. Mexico in general is very interesting. I just got back there and from there in March. A lot of infrastructure being built, a lot of de-China-rization, I call it. It's a technical term. And yeah, it's strategic position, low-cost labor, and proximity to the US with the ports, natural resources. It's a very, very interesting place. A lot going on in Mexico, keeping my eyes out there. So Braksem is the 6th largest petrochem company globally. Highly cyclical earnings. You can take a look at the volatility on this thing, and it's crazy. It has paid out quite a few dividends over the last few decades. So it's a very interesting company. 2 key points, really. This is what it produces on the right-hand side. Okay, so all those plastic resins, eyeglasses, this is just from the quarterly reports, and PVC, and lots of other different chemical compounds that I don't know how to pronounce, but they're in everyday items that are used, and a lot of those are, if not consumable, certainly disposable. They have a limited lifespan. They may not be one and done in terms of their usage, but they don't really have a long shelf life, with the exception, obviously, of some of these down on the left-hand side. Their feedstock. So they produce these things. What are their input costs? That's going to be the big thing. So in theory, the way I was looking at this particular investment thesis was it could form a nice inbuilt hedge, because obviously my portfolio in eToro is so energy intensive for reasons that I've spoken about for 3 years nearly now. This could be a good way to capitalize on any potential drawback, particularly in natural gas, which we've seen drop off quite a lot since last year. So in theory, their feedstock costs, when they lower, improves the margins on Braksem's and products. So what has happened recently, because the share price did take a dive before this recent buyout? Well, it apparently, and it was found, not apparently, I guess, that the hearings found that the salt and mineral mine that these guys were doing led to some geographical disturbances. And so they eventually led to, I believe, landslides or sinking earth levels in a town near where the mine was. And so they were found culpable. And so they had to pay out a large amount of compensation. They had to take on some debt in order to service those costs, but also their liquidity needs and ongoing operations until they can have cash flow to cover operations and to pay out the debt. The debt, as I'll show you in a second, is already more than half paid out, and there should not be any recurring costs. It's not like what would you say, like a chemical fire or heaven forbid, like nuclear meltdown, where there are ongoing like terminal illnesses as a result for which the company would have to pay. This is just property damage, and so once that's fixed, there's no reason to believe there'll be ongoing costs associated with the damages paid. Okay. Losses, I believe, are already well and truly priced in until the recent run up, of course. So here we've got, let me get that out of the way, just a snapshot of pertinent, I suppose, entries on the balance sheet. So here's what they have to provide for in terms of compensatory payouts. There's a little bit of a present adjustment of valuation, but as you can see, 7.2 billion of that 13 billion have already been paid out. And so when you're looking at their balance sheet compared to what their income is, they should have this more or less under control, and it will take up a fair amount of free cash flow moving towards probably next year and the year after. But it shouldn't be an issue in the long-term thesis of the company. Certainly, Apollo doesn't think so. The rumors are true, and they are willing to pay almost an 80% premium. Okay, so here they've got claims essentially, and the acceptance rates of those claims, and then really what it is they're looking to do about that, and they're already gone through 64% of the process of the demolition of I'm pretty sure it's close to the entire town, from what I understand. So obviously it was bad. They've gone through, they've done that, and they're looking to turn this around, and it looks like they're closer to the nadir than the peak in terms of the bad news. A one pager. It is in Brazilian reais, but you can see their market cap, shares outstanding. They've raised a little bit. Their net debt is a lot compared to the market cap for reasons which we spoke. Price to tangible book. That book value will be heavily impacted by the debt load on the liability side. That's about all there is to say on that snapshot. But here's where things start to get interesting. So if you look at the cash flow ability and the EBITDA of this company, on a market cap of 21 billion, nearly, we'll call it 9 billion from cash flows from operation, and about half of that goes into capex, half of that goes straight then to bottom line on free cash flow, at least as of last year. So that's giving you a fairly decent yield. Like if you're paying 7 times the free cash flow for a company with the ability to grow when the cyclicality is right, it could be very, very interesting. So market cap to free cash mean over the last recent periods has been 7, dividend yield has been 6, and EV to EBITDA has been 5. It's just so cyclical. It's hard to smooth that out. If when I was looking at this, if I said, okay, well, this is not something I can really map out over a decade because there's due to the cyclicality in the earnings and the cash flows, but it's been sold off. So it had been sold off so heavily. If we were to get back to sort of median level valuations, what sort of cash could this produce, and what might it be worth in the near to medium term? So, is the free cash flow per share using analyst expectations and then EBITDA per share? It's been obviously converted to US dollars. If you apply a market cap multiple of 8, it's an implied price of maybe 8.84. So, kind of neither here nor there. When I was looking at the entry point at $8.36, that's pretty close to the same, not much upside. EV to EBITDA, which is something I think would be used quite a lot for a business like this, because as we've seen Apollo's come in and looking at this type of business. I think if you were to say, look, what are the earnings potential of this business? Let's pay a multiple of that, and then we will systematically go through and try and create as much synergy as possible, or combine it with another company already owned by a potential acquirer. You could have quite a bit of synergy between the two. I'm sure the accountants will look at that. So if you were to use a 5.5 multiple for EV to EBITDA, 14.10, and if you average the two, looking at $11.47 is not an unreasonable valuation by the end of 2024. And that, at the time of entry, to me, represented roughly a 37% upside. And yeah, obviously that's basically been eroded now with the price as of time of recording at 10.53. But it gives an interesting insight. The solvency is interesting, shall we say. So they pay out these lumpy dividends, and that was what was attractive to me. Was I thought that they might look to pay out more as a dividend in the meantime to attract shareholder capital back into the company. If we look at EBITDA minus CapEx divided by interest expense, that is pretty low. So normally I'd like to see that at around at least 3 times. If you think about what they earn before they've even added in the accounting entries, then minusing out what they need to spend in CapEx to run the business, although they have been investing heavily for future production, that was a key part of the thesis, divided by how much interest expense they have to pay due to their debt load. It's a pretty thin line. So it was one that I was planning to keep an eye on and enter very slowly, in case something bad happened in the rollout of their CapEx. We'll see if the deal doesn't go through and the stock drops off again. Maybe I'll give it another look. Okay. So that's that. It's certainly shortened my presentation due to recent events. It is an interesting cyclical opportunistic play. It's already run a lot, and so I think it's very close to my current reasonable estimates of its intrinsic value. But looking at how much the company has spent in their CapEx, and how much they're looking to grow into the future, they may be able to grow revenue and hence earnings quite a lot. So it'll be interesting to see what happens. Other than that, I'm not really doing anything. I've sold out of the position and I'm just keeping an eye on it. So that's me personally. Do your own due diligence as always, guys. You're responsible for your own decisions. Thank you for watching, and I look forward to catching up with you in another video shortly. If you're looking for more interesting content this week, check out the Options Mavericks premium publication that I run. We've got a lot going on there, a lot of interesting plays, and you get access 7-day free trial, the typical Substack arrangement. All right, guys, take care, stay safe, and I'll see you in another video shortly.